Welcome to Grain IQ, an original production of the Nebraska Rural Radio Association. I'm Chad Moyer. Grain IQ is brought to you in part by the Nebraska Soybean Board as we partner in talking about, again, what's going on in the markets, some long-term risk management ideas, and again, getting some insights into what's going on. We are here at the Expo EDU stage at the Nebraska Ag Expo in Lincoln, and we're going to talk grains and we're going to talk livestock today. We have two panelists with us here today. First of all, Ross Baldwin. He is with agmarket.net, does corn, soybeans, does the grains, but also focuses a lot on livestock. And Matt Wiegand is with FuturesOne, based here in Lincoln. And he's going to focus a lot on crops here today. Since this is kind of a big, and we'll start big and broad and kind of drill down into some things that are going on in the markets right now. But since this is kind of designed to be an institutional knowledge podcast, we'll start with you, Matt. What are the essentials when it comes to marketing any agriculture commodity, whether it's grains or livestock, but specifically on grains, putting together a risk management plan? What are the essentials in your mind?
I think, a lot of the essentials to me comes from knowing your cost structure going in, what it's going to cost you to grow each crop, kind of where the potential is and where the risks are, whether you're dry land or irrigated, to plan forward, kind of where your insurance coverage is. There's been a lot of new insurance products added the last few years where you can cover some different margins, things that sometimes, provides a little bit better coverage than using traditional options or things of that nature. Also just trying to see in, what your plan is, where your cash flow needs are going to be, at harvest and into the new year, whether, you have the opportunity, if you have a lot of on-farm storage, there's a lot of years there's going to be carry opportunities. I think we're certainly coming into a year where we have that, at least into the first part of the year. Also just trying to, seeing, I guess with the break evens and moving that forward, I think is, knowing where you're at on that front is going to be key into the next couple of years until we see how the market develops as far as where trade's going to go coming forward, and as well as the increased domestic consumption with the new soybean crush plants and things of that nature. It's just going to take a little bit to get going, and that's where knowing where your break evens are, where your cash flow needs are, coming into harvest and post harvest are going to be key.
Ross, what are your thoughts in what are the must-haves of a marketing plan? Grains or livestock?
The first must-have, it's very similar to what Matt said, is knowing your break-even. Whether it's corn, beans, wheat, cattle, whatever the commodity is that you're working with, the first thing is know your cost structure and where your break-even is, and then build a marketing plan around that. And essentially try to take the emotion out of it. And I'm just as guilty as anyone. I'm a producer myself, and it's extremely difficult. In the cattle markets, what we've seen over the last 2 years, especially the last year, is it's been as volatile as we've ever seen. And every day that you wake up, you're more than likely long cattle, and if you're a grain producer, you're more than likely long corn or beans. Anyone that I've worked with, I've never really seen anyone that's been completely hedged 100% sold on corn, beans, or cattle. And finding a place to where you get that risk managed in a comfortable spot and something that you can live with, and try to take the emotion out of it. And it's difficult. It's easier said than done a lot of times.
Okay. Well, let's talk about, I guess, if you could say like the fourth quarter of 2025 here, starting on the livestock side, what are the major factors that are at play in the markets affecting livestock, especially leading into and here in the last quarter of 2025?
There's several major factors, obviously, across the cattle markets, but I would say some of the biggest headlines that we've dealt with and will continue to deal with is obviously the New World screwworm and the impacts that's had on the U.S. and Mexico border. That's really a never-ending headline, and it's going to continue to stay forefront to the cattle markets. Another major headline as we round out the year and work into next year is the Trump and the Trump administration's desire for lower beef prices, and they've went the route that they've went so far is lowering tariffs mainly on Argentina, and now recently he lowered his own tariffs that he put on Brazil, and he took the tariffs on Brazil up to 50% and then just took them off of beef, coffee, sugar, and some other commodities. But the big one was beef with everything that we're dealing with right now. Brazil, they still have a 26.4% quota tariff, And that goes into effect when they reach their quota. And in the last several years, Brazil reaches that quota by February because of what our beef prices have been. And so when Trump put his 50% tariffs on Brazil, that was also with on top of the 26.4%. So that completely halted any Brazil beef coming into the U.S. Well, he's since taken that 50% back off of them. So we're already starting to see an impact from the foreign beef, flowing back into the country.
So what is the practicality of the idea of doing that, just based on where we are at in the production system, and not only comparing cattle to cattle, but cattle to hogs, cattle to poultry, and things like that? Is it achievable what the administration wants to do?
Long term, I don't think it's achievable right now. Of how they're going about trying to get beef prices lower, it will have an impact. There is short term, it will have an impact. When you put those tariffs on and you completely halted Brazil beef from coming into the U.S., it had an impact on our beef prices. Our beef was already high because of the shortage that we're dealing with and the tight numbers in the country. But once you took them completely out of the mix on the U.S. side, it had a big impact. Brazil, then they flooded China with beef, and we went to Australia, the U.S. has. But in the big picture of things, with the U.S. numbers getting tighter out into 26, the U.S., I believe, it's been my opinion that we have started expanding the herd over the last year. It's not the big herd expansion, though, that we need ultimately. When I say what we need, we don't need that, because when we have a huge herd expansion, we all know what's going to happen to the markets. But as far as the markets trying to sort themselves out, we're not at that herd expansion just yet. And then you get out into next year, and Australia is in a rebuilding phase, and Brazil's not far behind them. So globally, beef globally is getting tighter out into next year. So what the administration is trying to do, I don't think long term it's gonna work. My opinion, what the administration needs to do is let free markets sort themselves out. And ultimately, if that means beef gets so high that we have demand issues, we all thought that was coming. We all know that's the end goal. That's what happened in 2014, and that's ultimately how markets, I feel that markets need to sort themselves out via supply and demand.
Yep. All right. Matt, same question for you now, but let's turn this and talk about grains. So, fourth quarter, we're behind harvest now, into marketing what we've got stored. What are the keys to the grain markets that they're trying to sort through going into, and what are we experiencing here in the fourth quarter?
I think the big thing, harvest is put to bed. You should know what you have at this point, what you raised, what you've sold, what's shipped, what's in town, what's on farm, what's in the bag somewhere, what have you. And having that knowledge and kind of knowing where you're at, I think is the big thing now, and can start to make a plan to move forward here. I think, as the market's trying to settle in here, we've gotten past the big harvest pressure, basis should start to stabilize. It's kind of an odd situation this fall. Your core movement's been very big. We're about 70% ahead of what we usually ship through fall, through the first quarter of the marketing year, which right now is about 275 million bushels. So a pretty significant amount. A lot of times when you see a big miss on a report on stocks, it's 300 million bushels plus or minus, and we're ahead by that pace shipping wise. So we'll see if that gets reflected in January. But while the pace has been big, ethanol production stayed very strong here. We also had a lot of acres. Harvest may be tailed off at the end, with disease pressure and things like that. But there's still a lot of corn around in the immediate term here, and that's kind of got to get chewed through. But we've put a pretty big dent into it. So as far as corn goes, the market's trying to stabilize, found the level here. Bean wise, we're kind of in the opposite boat here, where you've got shipments about 54% of normal. Every fall, the bulk of your soybean exports come from harvest till about the 1st of March, when Brazil comes online with their production. So we got the trade deal. I guess, doesn't seem like it's fully official yet, but, buying's been going on. We had a bunch of sales on the Daily Wire today. We're maybe halfway to the initial commitments, and then, longer term, we need to see that go. But with the shipment pace being what it is, while it's slowly ramping up, it needs to pick up the pace, I think, to give the market some push there. We priced in the optimism with the big fall rally. You gave everybody an opportunity to move bushels at the highest prices of the year. That's past now. We've acted a little bit better today, acting like we maybe have the short-term low here. So I think that's a good sign. Is just to get a lot more going there, you're going to need to see the shipment pace pick up. And then also into the first part of the year, as the biodiesel targets started to expand with the additional crush capacity. The soybeans get all the attention on the trade deal, but China, generally speaking, is a big buyer of milo. When the opportunity is there, we've seen really poor milo basis, especially into western Kansas, southwest Nebraska. We've slowly seen shipments pick up there. If milo shipments pick up, just on the smaller crop, you can see big basis swings there, and maybe something that materializes more for next fall. But that's going to be something to watch on the trade deal as well, as if that milo flow picks up and prices itself back out of rations for the Western Corn Belt feeders, as well as some of the Western ethanol producers. There's going to be some opportunities for you probably if the trade deal holds, if you're in a milo growing area.
Ross, we'll go back to you. A big announcement here in Nebraska, right? And it affects capacity to process beef. How did the trade deal with that, or is the trade still dealing with it? How is this all going to balance out, do you think, in the end, Ross?
The trade has dealt with the Lexington news. The Friday we went home after the markets had closed that Friday afternoon. Lexington or Tyson came out and made that announcement about 3 o'clock after the markets closed. We opened up that Monday, limit down. We had follow through again on the following Tuesday. And I believe by Wednesday or Thursday, we were back trading above the close on Friday before the announcement came out. So for now, the markets have shaken that news off, but that news is still going to be a headwind that we continue to deal with as we move forward. Because, the futures market's in a good shape right now because cash has screamed here over the last, call it, week. And the likelihood is cash is going to be quite a bit stronger again this week. And that's simply due to, over the last few months, we've had plenty of big market-ready cattle in the north, and we chewed through them quicker than what a lot of us were anticipating. A lot of them cattle went south. The southern packers been buying a lot of cattle from the north, taking them down to Kansas, Texas. But the inevitable is that on January 20th, Lexington's done, Amarillo's going to a single shift. That is going to be a major headwind for the market to deal with. The market today, we're long shackle space, and we have a couple new plants that are online. You've got the plant in North Platte, you've got another plant down in Missouri. Between those two plants, that absorbs a significant amount of Lexington going offline, but I'm not going to sit here and act like it's ever good when you lose a major packing plant. It's not. It's devastating, obviously, for the town of Lexington, but also for the cattle industry. It's a big headwind. I mean, we've seen what that does in the previous cattle cycles. When Cargill had one go off, Tyson's had them go off, back prior to 2014. But it adds to the headwind, I would say, more than anything. Right now, the thing that the cattle industry has on its side is the tighter numbers. And numbers will continue to get tighter as we head into Q1 of 26, Q2. So it's going to be a push and pull. What I tell producers, though, is don't get complacent. Don't start feeling too comfortable because there's plenty of headwinds. Obviously, Tyson's announcement's a headwind. The Trump administration, even though I said long-term, I don't think it accomplishes what they're setting out to do. That's still a headwind. Anytime you have the sitting U.S. president going after commodity industry the way Trump has been, that's a headwind. That's something that the market's not used to dealing with. And obviously the other headwind is the border situation with the New World Screwworm. Because as we work through 26 and the USDA's, their plans around, getting sterile fly production facilities brought online, every day that goes by, we're one day closer to the likelihood of that border reopening.
Okay. So how is beef set up compared to the other proteins? Because hog production, I think, came back from, they had kind of a push this summer. I think poultry has come back from the high path avian influenza. So how is beef situated compared to the other proteins?
Beef, we're going to continue to get tighter this next year. 25 production, the USDA was saying we were 4% lower year over year. And in the WASDE that came out yesterday, they're forecasting that we're going to see a 1% decline this next year into 26. But situated versus pork and poultry production is expected to go up. No surprise, as the poultry industry has recovered. Hogs, as you mentioned, the hog production had gotten tighter this last year, and that's largely been because of disease issues from earlier this year. Hog production, it looks like it's going to be steady out into 26, maybe sees a 1% increase by the time it's all said and done. But when you combine the three protein sectors, I don't see anything too burdensome, especially when we look globally Australia and Brazil entering rebuilding phases for their beef herds as well. It's all going to coincide at the same time that the U.S. market, we're likely going to hit our tightest period.
For the time that we have left now, let's take an outlook view of some of these different sectors. And Matt, we'll start with you. How are things set up going into the big January reports? January is when we get final production numbers from the prior year. So what's the situation? What's kind of the thoughts going into that big report in January?
I think the big thing is, there's going to be a lot of looking for corn yield to be reduced. We didn't get a big reduction on the delayed November report. And a lot of times, maybe we don't get that final reduction that everybody wants. But I think, where that number kind of settles in is going to be a big thing. But the actual stocks number, I think, will probably be the bigger thing that day. You're seeing where the usage is, and if the stocks number is lower, you'll probably discount whatever yield number we get there. Being wise, I think the big thing is you could see a shock on a bigger stocks number just because of the low shipping pace. We've had great record crush the last few months. That's probably not going to completely offset it, especially during the big part of your shipping season. So, where that comes in is going to be a lot of it. You maybe see a little bit of a bean revision down just with the dry finish, and especially in the Eastern Belt. So we'll see how that sorts out, but probably not going to be a material change there. You also get a wheat acre number. The important thing there, you see if we did get some wheat acres back late and where that goes into the overall pie, because coming off a year where we had giant corn acres, small bean acres, and we really haven't shifted the corn soybean ratio enough to really see a major shift there yet. How that sets up coming in the spring is going to tell us a lot.
Matt, what do you think about basis, especially after the holidays? Because I know basis can shift based on production schedules and things like that. But going into January and starting to market grain in the next calendar year, what's the story on basis?
I think we'll probably see it stay mostly flat. Demand's good, but you get the first of the year bump and just kind of that movement there. I don't think we're going to see it fall out of bed. I just don't think we're going to see major pushes right away. It's stuck in a spot until we get the shipping component really working harder for you and getting the movement going there before it can see some real strength as far as that goes. But we get some good futures moves, and we keep basis flat, still going to provide some potential opportunities there, especially if we get stuff more squared away on the trade front.
All right. Ross, over to you. Again, kind of the outlook for marketing cattle as we get into 2026. What is the market asking for right now? Is it still asking for heavy cattle, or are we going to get the North back to current and try and get into a position where the producers have a little bit of leverage? What are you thinking going into January?
I would say the packing industry has been asking for the heavy cattle, and as cattle feeders, we've delivered that. And it's been an interesting phenom to where any other market, when you're not in a bullish market, overfeeding cattle the way that we have, our feedlot included, it doesn't work. And it has paid you to do it right now. And your cost of gain's cheap. Corn being the key ingredient, but that cost of gain is extremely cheap. And that coupled with the leverage that the cattle feeders have had, that created a phenom this last year that we had never seen across the industry, where cattle feeders were able to feed cattle longer, keep them off the market, and basically demand to the packer what they wanted paid for them. And that worked a lot longer than what we thought. Now we hit the last few months to where in the North, we had a lot of big cattle, and we saw what happened with the leverage situation. It shifted. I was under the opinion that here over the last month that by the end of December, we would get these big cattle cleaned up. It happened quite a bit quicker than what even I thought. I mean, we saw that last week when cash jumped to $10 to $15. But numbers are so tight in the South, and especially in Texas, and we've seen that in every cattle on feed report with placements non feed. And the driver of that, the large driver, has been the closure of the U.S.-Mexico border due to New World screwworm. But there, over the last couple months, has been so many fat cattle going south. Even from our feedlot, which is southeast of Sioux City, we shipped several loads of cattle here a month and a half ago down to a plant in Texas. And that is a long ways to go, obviously. And so that's what helped clean us up so much faster. We've got tighter numbers coming, and just the way that the South pulled so many cattle from the North is what's got us to this point. Looking out into 26, numbers are getting tighter through Q1 and Q2. Does that mean the market's going back to the highs of, April futures got up to 252, I believe? I struggle to think that given the headwinds that are in front of us. Now, recently we sold the live cattle market off $40 to $50, and the feeder cattle market was nearly 80, or I should say 40 to 50 cents a hundredweight and 80 cents a hundredweight on feeders. We've recovered 50% of that sell-off here, both fats and feeders. We're kind of consolidating right around this 50% retracement level. I am optimistic that cash can work higher, and especially as we work out into next year. I really think cash can work higher. Does it go make new highs above 250? I struggle with that 250 number. We had all the leverage in the world here when we got up to 245, 247, and the Packers were not paying 250. So with all of that said, I mean, as you have cattle on feed and risk needs managed, just be mindful of there is headwinds. I mean, this bull story, we've been in this bull run arguably since April of 2020. Now, the windfall profits didn't start until about 23, but this is a very developed bull market that we're in, and you've seen the longer it drags on, the headwinds that start coming from other factors. So manage risk, even if it's having some puts or some LRP underneath of it, just do something to prevent a bad day. Because I think your feeder cattle have been screaming higher, and I'm still bullish on actual feeder cattle prices in sale barns as we end out this year and work out into next year. It's going to be hard to crack that physical feeder cattle market. So if you're a cattle feeder finishing out fat cattle, you're going to continue to have expensive fat cattle on feed, and just at least have something to when you go to bed at night, you know that you have a disaster, for a lack of a better word, prevented. And when I say disaster, I'm talking when cattle are going to start losing over $500 a head, because we all know how it eventually ends at these high prices.
Yeah. All right. Questions from the crowd. What questions do you have? Hand in the air. There we go.
Yeah, question for Ross. Talking a little bit about national cattle herd expansion, is there a certain thing you're watching for to see when that's happening? Is it percent of heifers in feedlots, or what's kind of your signs you're watching for that?
So the biggest thing to watch really on that is heifers on feed. And we get that quarterly in cattle on feed reports. And the other, I'll hit on that real quick, but excuse me. The other biggest thing to watch is the January semi-annual inventory report that comes out the end of January, because that will show you the herd size and then the beef cow herd and the numbers there. We did not get that report. So when we get that report updated here this year, that's going to be a big one to watch. Now, the heifers on feed and the cattle on feed reports, I believe the last report was 37.5% on feed. Typically, when that number, you start getting below 35%, that's when you have a more meaningful herd expansion occurring. During 2014, I believe it was 2014, 2015, the low number was 31% is what we got down to, heifers on feed. And we all know how that ended. We were literally keeping every heifer back that we possibly could in this country. Now, to take it one step farther, the difference between today and 2014 is beef on dairy crosses. The beef on dairy crosses back then was, I don't want to say non-existent, but it was nothing like it is today. Beef on dairy today accounts for 3% more heifers on feed than what we would have had back in 2014 if you're trying to compare the two, apples to apples. So a 35% today would be likely equivalent to a 32% back then. So my only caution is in saying all that is we don't need to see that 31% number today to think we're keeping everything back that we possibly could, because a 34%, which doesn't seem, terrible. It's plenty of heifers we're keeping back. It's just completely different though. So just a couple of numbers to watch, but that January inventory report is going to be a big one. And the thing that I'm curious to see in that is if we have reached a low point in the U.S. herd. If we haven't yet, just in that report, then we're very close. I feel like 26 is probably the low point in the U.S. herd, I would think.
Can I add just a little anecdotal thing to that? Just talking to guys that sold feeders this fall, they noted that, a lot of cases, up to 2/3 of their heifers just going through the big barns at Kearney or Lexington were being bought for breeding. And you've seen that retention show up on the fall run on the, the cattle that were going through there that, last year that was 0%. So it's, been a bigger shift there.
What other questions do you have? Matt, I've got one for you.
All right.
On our risk management, use of options. Is there value where the grains are now? Are there, and where the carry is? Is there value in using options today?
I think the biggest, I think there is value. One of the biggest thing I'd look at right now is, with the corn market being flat, commercial storage being what it is, you can buy at the money options cheaper than you can store it in town. I think that's, if you want some upside, you can stop storage, you can move it along there. I think that's kind of where your biggest value is right now.
I almost hate to bring it up, Ross, but I'm going to. The insurance products, LRP, things like that. Is there, with the value of these feeders, is there a place, should we be considering that, do you think?
I think you should always be considering it, I would say. And the LRP is very advantageous on the feeder cattle side. The fat cattle side, it's not as advantageous, I would say, just given the difference in regions for cash trade. But on the feeder cattle side, if you're a cow-calf producer, here I'm going to bring up the government again, but it is one good subsidy. It's a subsidized put by the government. It's a cheaper put option. Now, you don't have the flexibility, obviously, to get out, or, you're married to it when you put it on. But for a cow-calf producer, I would strongly encourage looking at LRP and, locking in at least a floor underneath of your feeder cattle, especially at the levels we're at. In this feeder cattle market, if you're a cow-calf producer, you have a good idea of where your fixed costs are. And with where the feeder cattle market is, you can floor some extremely lucrative levels.
Yeah, I editorialize just a little bit. I say it's a subsidy, right? It's encouraging you to do something, right?
Yep,
it
absolutely.
It is a marketing plan that you're committed to. It's got to be a good thing, right?
And I would add with the LRP too that while it's not as flexible, if we do have a hard move down, you would have the opportunity to buy calls against it and effectively lock in gains that way, or something too, that you can use it in tandem with other strategies as well. It's not the end all be all.
Sure, absolutely. Hey, everybody, would you please give Ross and Matt a round of applause for being on our panel here today? Again, thanks to Ross and Matt for being on with us on today's Grain IQ program. Again, be sure you look up those other Grain IQ programs wherever you listen to podcasts, listen to those prior sessions. And again, thanks to the Nebraska Soybean Board for sponsoring in part the Grain IQ program today. I'm Chad Moyer.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.